friends. So today we'll be looking at quantum ELSS stock selection process. So to begin with, what are we trying to do in quantum ELSS fund? So to describe it very briefly, so if you want to look at any particular stock which has an intrinsic value of 100, which we deem has an intrinsic value of 100, our whole endeavor is to buy it at a minimum discount of 25%, so that 100 becomes 75. If we do our work right, we want to buy at a minimum of 75. So for a certain set of stocks, the discounts could be higher depending upon which industry do they belong to. And if you are correct in our estimates, over a 2-year time frame, the stock should again go back to its intrinsic value. So the 25 rupees delta that you get on 75 equates to around 33% return over 2 years, which is roughly around 15.5. So this is what we are trying to do. This would be roughly double of what you would get in a typical 10-year Indian GSEC. So what I'm trying to do is to explain how we go about selecting stocks which fit into this particular criteria. So where do we find such opportunities? So this is typically how the stock moves, how the stock reaction moves with respect to its earnings and the business cycle that it finds itself in. So the green line that you see is essentially how a typical company's earnings would compound a period of time if you were to pick a growing sector. Case in point would be a banking sector over a 10-year horizon. This is how the EPS growth would have been. It is generally tending upwards. Same is the case within IT services or any other such large industries. But the earning trajectory of a company in the near term could be quite volatile, which is depicted in through the blue line, which is the business cycle. And when we see if a company reporting, let's say, not so great numbers, there is a stock reaction also to that, which is measured by the orange line that you see. So generally, the stock reaction is amplified in both directions when the companies report good numbers as well as when we report bad numbers. So typically for us to enter into a particular stock, we would choose, when the earnings are kind of troughing out in an industry which is more or less growing, right? So this is another version of the same chart. If you were to amplify, us being value managers, we typically get interested in the company when, the earnings cycle perhaps in the near term could be weak, or, there could be some of the other pressures because of which the stock reaction is a bit more amplified in the negative. That is where we get fundamentally sound companies which are trading at a discount to intrinsic value. So the key question to ask at that point in time is the share price correction due to the earnings decline, is it cyclical or structural? There are quite a few industries, that we encounter where the earnings trajectory is subdued structurally. So I'm not referring to that, but if we think, in a fundamentally great sector, which is having an issue in the near term, and the earnings were to rebound in line with the industry over a longer period of time, that would be a great place to get in. And that is when we would typically get in. And we would exit also, when the profit cycle is on the upward trajectory and the stock reaction generally to that is a bit more amplified on the higher side. That is when we see the company moving towards its intrinsic value or, surpassing it. That is the point in time when we would be typically exiting out. So what does this process, boils down to? So, when we really want to analyze this particular style of investing, it is very predictable. As you can see, one of the fundamental predictability driver, or one of the important factor according to us that you should look into a portfolio is the portfolio characteristic. So when we have a discipline process that I alluded to just a while back, we should also, this the outcome that you will have is a portfolio characteristic, which is also quite predictable. So if you were to look at the dividend yield in our ELSS fund, it will be typically a bit higher than the benchmark because of the value bend. The multiples would be cheaper. The case in point, now we are trading at around 10% discount to what you have in narrow index like BSE Sensex. And the earnings growth is maybe in line with what you see with the BSE Sensex. So this portfolio characteristic is also consistent over time because of the process that as I just alluded to. The other aspect that I want to speak about is the predictability of performance. So typically, given the style in which the fund is managed, which value bent of mind, what you will have in a typically up cycle. So these are the three long-term charts in GMC crisis where the markets have gone through various ups and down cycles, the bull and the bear phase of the market. And typically, a value fund would kind of outperform in the bear cycle, but maybe underperform a bit in the bull cycle. And across these cycles, that is what quantum ELSS fund has delivered. So typically, we see in the bull cycle we are catching up in terms of returns, but in the bear cycle we tend to outperform, across the time frame. So the process that we follow, which is quite disciplined, will result in a outcome which is also fairly predictable. So that is the key thing that one has to bear in mind with quantum ELSS fund. So these are the long-term returns as SEBI would define it. So thanks, friends, for listening to this conversation, and may you have a great time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.